the US is not considered one of the top financially free countries, quote unquote, in the world. But the fact that people can't access money the ways that other people can, or get access to loans at affordable rates like others can in other countries, is just crazy. Where we play a pretty big role is the way that a lot of these developers fund what they're doing is with what's called, and this is US specific, is a low income housing tax credit. Its acronym is LIHTC. What happens with low income housing tax credits? One, only about 50% of applicants receive them, and those applicants are generally much larger developers. And so we work with some developers who've gotten them. When they get these credits, it takes around 6 months to a year to apply and then to get notification that you've been granted them. It's going to take another 6 months to a year to actually receive them. So let's say 1 to 2 years of waiting time just to get these credits, and then you sell them to banks and investors. And that's how they fund these developments. That's where we come in. These are the types of projects that are perfect for us, and this is the gap that we can fund while developers are waiting. At this point, we've found a pretty fair model that both provides stable returns that outdo US Treasuries. They're short term. It's a better return for some people compared to a fund where you're locked in for, say, 3, 4, even 5 years, and you're still having impact. You still have transparency. And to us, it seems fair. Everybody's rising, not just one group. Not just folks who are looking for affordable and workforce housing are rising, but they're rising, our team is rising, investors are rising, communities rising, and so everyone's doing well together instead of it just being isolated to one group.
Hey Liz, it's good to see you.
Hi, Makiga. Nice to see you again.
So, with all of these, I'd like to start at the beginning and just get a sense of you and your background, where you're from, where you grew up, where you're based now, and then a little bit about your professional background.
So, Elizabeth, Liz Kukka, I'm from the Bay Area, born and raised there, lived there for about uh, 30 some odd years, and then moved just outside of Los Angeles about 6 years ago.
That was pretty quick and easy. So now let's dive into your professional background. I know it starts with you becoming a public school teacher, and why don't we start there and kind of work our way forward?
Yeah. So background in environmental science, fell into public school teaching, worked with at-risk youth in San Francisco, did that for about 7 years or so, and quickly realized that I didn't want to become a school principal and I didn't want to go to Sacramento or Washington, D.C. Principals just have the worst of the worst jobs. And so after about 7 years, I went back to school to get an impact MBA. So it's an MBA that's focused on the triple bottom line, that's people, planet, and profit, with the goal of figuring out how to develop sustainable business models that were impactful. So I did that for a couple of years in San Francisco, graduated, thought I would end up at a Fortune 500 trying to change it from within and convincing Fortune 500s to diversify and divert their capital towards real change. That did not happen, unfortunately. I ended up over at Plug and Play Tech Center working in the startup world instead. So Plug and Play Tech Center, it's a global accelerator program based in Silicon Valley. And so I needed a job. I also wanted to work in tech. And so I spent about a year and a half there running global programs. So ran two programs in Silicon Valley, a program in Munich, a program in Singapore, in Beijing, and then we were looking at London as well, but I left before that happened. While at Plug and Play, I met a ton of entrepreneurs and startup founders who kept talking to me about Bitcoin and Ethereum and EOS and Ripple and all of the originals. And they were all trying to convince me to join their tribe. And it was all interesting. And where I got kind of hooked in, this is back in 2016, 2017, where I got hooked in was on the privacy preserving component. And as being a longtime activist, that was really important to me. How do I and others have some sovereignty and agency in what happens with our data? And how do we not become objectified in sales cycle if we don't want that to happen? So how do we have some agency there? So that was super interesting. And then I really appreciated the peer-to-peer component and removing as many middle layers as you can, as well as transparency, not having to have reliance on banking systems. Why can't we move our own money amongst each other? Why can't I hold it myself without putting it under the mattress and also earn some interest on it? And so those were the key drivers. I started hosting events at Plug and Play in 2017, dedicated to privacy specifically, and then left to join Digital Finance Group in 2018 to help design and launch Ethereum Classic Labs, which was the first accelerator for the ETC protocol. So did that for about a year and then went back to the parent co and did a bunch of different finance things. So launching a fully regulated exchange in Abu Dhabi. So got to work with regulators in the MENA region, launched a fully regulated custody business called Digital Custody Trust Company in South Dakota, working with the South Dakota regulators, working with lots of lawyers, helped launch a hedge fund, was also on the investment venture side. After doing that for 2 years, so 3 years total at DFG, after doing the parent co side for 2 years, really just stopped and wanted to take a look at what I was doing. Went back to school to get an impact MBA, had been this like lifelong activist, and now I was building services, not really solving anyone's problems. I was providing services and solutions to people who could really, quote unquote, find alpha anywhere they wanted in the world and get access to anybody that they wanted. And so it wasn't why I joined Web3. So I left and went over to a friend's company, a really small startup, and did that for a handful of months, and then went over to ChainSafe Systems and helped them with business management for about 2 years. And so ChainSafe is been around since 2017. They're based in Toronto with an office in Zagreb, in Berlin, and a remote virtual office in the US. So at ChainSafe, they're a R&D team building client solutions for Ethereum, for Filecoin, for Polkadot. They've built privacy solutions for Gnosis, for Aztec. They've built solutions to bring gaming assets on chain. They have a bridge that used to be called Sigma. I think it's called Sprinter now. It's a pretty cool team, very technical, mostly engineers. After 2 years, maybe even earlier, again, I was like, but this is still not the social impact or environmental impact I'm trying to make. So even though amazing team, super smart people, deep in Web3 ecosystem and networks, it still wasn't the kind of impact I was looking to make in the world. And then that brought me to Purpose for Profit, which is now called Lane 3. And so I met my then co-founder, Clarence Wooten, probably a year and a half, 2 years ago now, and I had met him years before that. He had this idea of how might we use blockchain and crypto to help with housing. And so his idea was to develop NFTs, do a big NFT sale. It was a nonprofit, by the way, raise a bunch of money, and then fund affordable housing. I don't come from the NFT space, not really. And I also don't have a deep network within the nonprofit sphere, so like philanthropy or charitable giving. And neither did he. And so the business model or the approach was quite difficult to get moving. So we ended up going separate ways and approaching the challenge in our own way. So me and the team left. We spun out to Lane 3 just in May of this year.
That's amazing. Thank you. Yeah, I mean, it's quite a journey. You've touched on a lot of different industries and spent a lot of time with a lot of different ideas and groups of people. So this is an interesting conversation because it's the first time on No Signal that I'm interviewing someone who I've interviewed before. And of course, that when we first spoke, it was still Purpose for Profit, and that was how I oriented the piece that I ended up writing. I think at the time when you were talking about ChainSafe, you described that crew as a bunch of anarchists in a very endearing way. And that ended up being the basis of the piece I was writing. Via David Graeber, who is a significant
Mhm.
like a character in the Kernel book, and it was an interesting lens to look at the work that you're doing, especially given all the activism that you've engaged in your history working in public school. First, to learn a little bit more about the transition from Purpose for Profit to Lane 3. I wonder perhaps the way to explore that is to hear a little bit more about your decision to transition from a nonprofit to a for-profit.
The reason why we decided to transition from a nonprofit to a for-profit, which is what I thought we should have done from the beginning. So when I first met Clarence, I was like, dude, we should do a for-profit. This should be, if not a venture-funded initiative, then a crowd-funded initiative, but it should be a for-profit for a lot of reasons. So to answer your question, one, because I don't have a lot of philanthropic connections or charitable giving connections. Two, From what I've noticed and from what I've heard, even from people within that space, a lot of money is drying up or disappearing from the nonprofit sector. People are disappointed or frustrated with the impact that nonprofits are making. They don't see there being enough transparency. They're not moving fast enough. And so there's already a lot of drying up in the nonprofit sphere for organizations that have been there for 10 years, 20 years. There's some that are still the really large ones that I'm sure are doing tremendously well, but from friends of mine that have been in this space for a long time are having a difficult time continuing to raise money. The third piece is that it's not a sustainable business model. And no offense to nonprofits, I think they're amazing and maybe will become one again someday as like one arm. But it's oftentimes not a sustainable business model because it's based on charitable giving. So there's not a self-reliance there. You're not able to depend on your team, depend on community to support the work that you're doing. It's this constant charitable giving piece, similar to Ethereum, right? Depending on volunteers to keep it going to the point where people burn out and like don't want to do it anymore. And so that's another reason why when I've talked to social impact investors, and even folks who are philanthropic, they still want to know what's the return. And so it's always mind blowing where I think like, oh, I thought you just wanted to do good and get a tax write off when we were a nonprofit. And no one really cared. They already all had their tax strategies in place. They already all know how to play all of these different financial games. They didn't need us to help them do that. And they already had their special purpose or special interest area. So there's just so many reasons not to do the nonprofit model. When first starting Purpose for Profit, again, now it's lane 3, when speaking to a bunch of crypto friends in this space, even a lot of them who are impact oriented wanted to know when we'd be able to give them even more tokens. So if it's not equity or if it's not a traditional investment, like when more token. And so it was always really difficult in our early conversations. People either wanted more money or they would then ask, well, how are you going to make more impact? It was like no one was ever satisfied. But at this point, we've found a pretty fair model that both provides stable returns that outdo US Treasuries. They're short term. It's a better return for some people compared to a fund where you're locked in for, say, 3, 4, even 5 years, and you're still having impact. You still have transparency. And to us, it seems fair. Everybody's rising, not just one group. Not just folks who are looking for affordable and workforce housing are rising, but they're rising, our team is rising, investors are rising, communities rising, and so everyone's doing well together instead of it just being isolated to one group.
Yeah. Can you outline the mechanics a little bit of how you've orchestrated this balance?
The way that we have it set up today is that we have a product demo. It's not live. It looks a bit like it's kind of a marketplace look and feel. We have a borrower pipeline of $30 million. We've stopped adding more potential borrowers at this point until the platform goes live because then people are just waiting around. We charge a certain amount to the borrower, and then we share a portion of the margin essentially with our investor base. So, for example, we have a borrower who's done close to $1 billion in development across the country, all impact-based development. So it's affordable housing, it's housing for veterans, it's workforce housing. For them, they would be borrowing 10% total, and then our investors would get somewhere between 7 to 8% back. And so then we would be taking a 2 to 3% margin. The difference between us and a fund is there's no fund management fees, so it's not a fund, but just trying to explain some differences for folks who know about that world. There's no fund management fees, there's no carry, and we're also a tech company, so there's smart contracts involved, there's audits involved, there's ongoing security and monitoring involved. So that's why it's a little bit more expensive when it comes to that margin that we take, where a fund might take anywhere from 0.5% to 2, where we'll take up to 3 because we're a tech company and we're not a traditional fund. That's pretty much the structure. And then on the token side, both borrowers receive tokens when they repay their loan. And so it's the kind of a network effects model to encourage borrowers to come back to lane 3 again and again. Um, Borrowers can also choose to give those tokens to their own communities. And so we've had multiple potential borrowers ask us that already, if they could then give tokens to people who are leasing from them, who are renters, who are living within their community structures for doing things like attending HOA meetings, volunteering in community, going to a skills training, and so on and so forth. And so that's on the borrower side. On the investor side, it's really similar. So for every dollar put in, dollar comes out in token, while the loans themselves are all USDC and USD based for now. And then community, of course, can also participate if they're not accredited investors, because right now it's only for accredited with check sizes of 25K and above. So for non-accrediteds, they can use the Lane 3 token and participate in staking, which is essentially our first loss layer in lending. So that layer protects against default, but then also gives you a higher return on investment on tokens. So instead of 1-to-1, you'll get 2-to-1.
Cool. And then I wonder if you could give an example in a more traditional model of what percentage a borrower, a contractor in the affordable housing world, what would a deal look like that they would get from a more traditional bank?
Okay, I'm going to try to be as linear as possible, but it's almost impossible for me to do that, but I'm going to try. So, I'm going to speak to what they would get from a bank, what they would get from private equity or an investor. I can speak also to community banks, grants, and then really where we participate and make the biggest impact. So, one of our partners, who I mentioned just a bit ago, who's done a bunch of work cross country, they will get from a bank, it varies, but say 4 to 5%, even up to 7%, but the bank won't cover the entire loan. They'll only cover portions of it. Same thing with private equity. They only want to invest in portions, and it's generally at the later stage of development that everyone's interested in because that's the closest point where revenues will flow from either the sale of a property or from rents, from rental units. Everything else before that is considered riskier and more importantly takes way too long. Could be 2 years, could be 3 years, depends on permits, licensing, and all of that stuff. So there's that. And then for short-term loans, which is what we do, this is 6 months to 18 months. We're Web3 first, we're Web3 native. We're not trying to do a 5 year. I don't know anybody who does something 5 years in this space. Even 6 months is kind of long for us, to be honest, but 6 to 18 months is the duration. It's also a massive gap in this space. And so if you're going to look for a short-term bridge loan, you're looking at anywhere from 10 to 25% that you're going to pay. And so we're at the very bottom and oftentimes cheaper than 95% of what's out there for short term specifically. Where we also play a pretty big role is the way that a lot of these developers fund what they're doing is with what's called, and this is US specific, is a low income housing tax credit. Its acronym is LIHTC. And so what happens with low-income housing tax credits, one, first and foremost, only about 50% of applicants receive them, and those applicants are generally much larger developers, so like hundreds of millions, billions of dollars that they've done, or they can afford big legal teams to help them get these credits. And so we work with some developers who've gotten them. They're for 4 to 8%. When they get these credits, it takes around 6 months to a year to apply and then to get notification that you've been granted them. It's going to take another 6 months to a year to actually receive them. So up to 2 years, could be faster, but let's say 1 to 2 years of waiting time just to get these credits. And then you sell them to banks and investors. And that's how they fund these developments. That's where we come in. And so while you're waiting for 2 years to move a project forward, you've had to pay for the land, you've had to pay for the permits, you've had to pay to get to prove that you actually had this project that you're going to build and bring to market. And then you have this big waiting period to get the credits that you can then sell to fund your work. And these are the types of projects that are perfect for us. And this is the gap that we can fund while developers are waiting.
You described yourself, or you described Lane 3 as Web3 first, Web3 native. I imagine a lot of the borrowers that you're working with are less familiar with that territory. I'm curious how those conversations have gone, if there's been any pushback or hesitation like when you're talking about these mechanisms.
Yeah, for most of the borrowers that we've been connected to, they've either come from my network, my co-founders network, our team's network, our advisors network. So I just want to say that first and foremost. And so we've been having conversations with folks. And by the way, it says my connection's really bad. So sorry. Hopefully you can hear me. So we've been having these conversations with borrowers for almost a year. And so people have been very excited and supportive and patient as we've been doing this work. And so I say that because when we first started chatting with people, we talk about Web3 and crypto, and no one knew a thing about Web3 or crypto. They thought it was shady or a world that wasn't for them, or they just needed a lot of education. And sometimes we even asked ourselves, should we stop talking about Web3? Should we not talk about crypto? But it was really difficult because it was just hard to talk about the tech without talking about wallets or talking about sub accounts or how custody and escrow would work. It was really difficult. We didn't want to hide anything either. It's like, this is what we're doing, and this is how we're going to do it. And this is how we think we're going to make a difference and help support everyone else making a difference. And we think Web3 is the way. So in the beginning, people were not hesitant, but not excited, I guess you could say. But over time, that's definitely changed. We've also started asking people, instead of just saying, this is going to be on chain, we started asking people, would you be comfortable deploying your loan on a smart contract? And so we had to shift our language a little bit. And as soon as you start asking people instead of telling them, right, you're inviting them in, you're giving them agency as well to decide. Everybody's like, yeah, that's fine. As long as there's no risk to me and me getting my money, like, I don't care. And even that conversation has now shifted to, you're doing this thing. We want to get in. We want to figure out how to be in this world too, which was our hope to begin with, was like, impact real estate developers are the community, or they're a part of the community, right? They're the subject matter expert. They've been doing this for 10, 15, 20 years. They really should be a key part of the community and have a strong voice in it. And they're super experienced, so their opinion matters. And so we positioned it like that for a lot of folks in the beginning, like, you're the hero in this story here. We want to bring you in. Let's give you a home within the Web3 world. And they just didn't really know what that meant. But over time, folks have gotten pretty excited about it and get what we're trying to do and want to participate. I want to figure out this whole Web3 crypto thing. They still want a lot of education. They still need a lot of hand holding, but at least there's interest and excitement about it.
Okay, so that is on the borrower side, and you said you have about 30 million locked up there. What about the investor side? How are conversations going there? What's the status of that group?
Yeah, so we've been trying a few different things, which is probably not helpful because it's not super focused, but it's spread. So on the investor side, we're doing three things at once, which probably sounds crazy. We're raising venture to get the platform built out, not a massive
Mhm.
round. We've also been looking to raise what's called a lending facility, or like a lending club, where a group of investors pool money together that we can then draw from. It's really no different than a lending pool, but it's almost like a private lending pool. And then we can do draws based on the specific project, get the money out, get it back, rinse and repeat. And so on that side, we were looking for anything from like 25 to 50 million. But again, we wouldn't pull it all at once. It'd be specific draws on a project by project basis. Everybody would have transparency and insight into where the money's going. We've had more success talking to Web 2 investors to do this than Web 3 so far. We haven't given up on the Web 3 side, and we'd prefer to do it in Web 3. Like, come on, treasuries, just give us a pull of $50 million. So far, it has not really moved too much. Again, traditional different finance organizations have been way more receptive to what we're doing than the crypto side, because when we pitch the lending facility, there's no crypto involved. It's like, we're converting USD to crypto. We'd take our margin to pay for smart contracts and to pay for audits and all of that stuff. So they don't need to see the other side. And then we also have a few projects that have been waiting to work with us, where we're just literally looking to get them funded as soon as possible, just to prove this model out. So it's not venture, it's not a lending facility, it's a traditional short-term debt-based offering. And on that side, we have around 2 to 3 million of angel dollars that have said that they're interested. It's just about getting it over the line now and getting that capital in the house and then deployed. So we haven't talked to like dozens and dozens of people about participating, because it's been a lot of chicken and egg. What do we do first? And how do we just get this thing moving? So right now we have two specific deals that we're looking to get funded. Both are in Northern California. One's in Belmont, one's in Fremont. They're both in the Bay Area. I don't remember the total cost, but they're like 30 or 40 million dollars or something like that. And it would be 2 million per project that's being raised at a 12-month term, with an interest rate 8% over the course of the 12 months, plus tokens on top. This is with that borrower I mentioned before who's done over $1 billion in development to date in California and New York and Atlanta, doing a lot of impact-based work. They do about 15 projects per year. They've been in this business for like 20 years, never defaulted, great track record, all of that good stuff. And so, what this would enable us to do, we would take just 2% on this one specifically. But what that would enable us to do is to build out the platform, do the smart contracts, the audits, and bypass or skip the venture side and just get a little bit of money going so that we can prove it out.
Right. Makes sense. When you're looking at the token economics and you're balancing all of these different types of stakeholders, are there any existing protocols or models that have inspired you or that you're looking at pretty regularly?
There's the three big ones: Goldfinch, Maple, and Centrifuge. All three are great. Aave, of course, as well. So all three, Centrifuge, Maple, and Goldfinch, all of them have done the private credit model. I think what they've done has been really good work to date. None of them are focused on housing or impact specifically. And so that's where we differentiate a bit. We're also not automating decision making. So what you see a lot in Web3 today is um, it's a pool of resources, folks vote, money moves, and you're trying to be as self-service as possible. But when you're moving millions of dollars around and you need to do deep diligence on who's borrowing the money and you're managing other people's money, essentially, we're going to go quite a bit slower to start. And there'll be some manual components. We also have a lending committee in place. It's essentially people who have 15 years plus of lending experience. It doesn't mean that community members can't participate in that, but we're, for now, preferencing experience, I guess, over curiosity to start at least. In time, we would love to have a pool of funds dedicated to new developers. So, not people who have the $1 billion in previous developments, but instead people who are just trying to get their feet wet and get started, who also can't access capital because they don't have a track record. We'd also like to do that quite a bit, but that's a later stage. So, yeah, Centrifuge, Goldfinch, Maple. I think with Aave is probably doing the latter part of what I just mentioned, where there's a pool of funds that more newcomers or new entrants can tap into. That's not really Aave's focus, right? But there's also no limitations or restrictions, or there's not so much vetting involved, I guess you could say. And so there's even more accessibility there. So I really respect and appreciate that. We're not starting there though.
Totally. Yeah, and then on the community side, for the non-accredited folks, have you been engaged in conversations with people who might participate in the protocol more broadly like that? Do you have indication that that is an attractive proposition to people?
There's a broad range of folks. We have a lot of people interested in what we're doing. We're still trying to figure out how to position this for developers specifically, like developing open APIs, what kind of data might be interesting for people, specifically to bring transparency to housing development, because it's a pretty opaque world. So the cost of materials, the cost of time, there's so much negotiation and backdoor deals happening that it makes it really easy to inflate prices, and it makes things more expensive to develop, and it makes it harder for everybody. And so we're trying to explore how might we bring tech into this to bring more transparency to the space and bring costs down. Monitoring the network is another way to bring in engineering. But at this point, yeah, it's still not clear.
I was thinking a lot about REITs, real estate investment trusts, and how they have kind of democratized to a certain extent real estate investment with liquidity and professional management and a bit of transparency. It's not on chain. But I'm curious if you've looked at those at all in considering your model and if those have been a factor or a source of inspiration.
Yeah, I love REITs. I think REITs are pretty cool, especially because it enables people who live in a specific community to participate in investing in their own community. And you can bring the cost down tremendously so that folks can participate who wouldn't be able to otherwise. From what I understand and from what I've looked into, it's pretty expensive to launch a REIT, like in the $1 million range. And I don't know if it's on a project by project basis, but it's pretty expensive. So we thought about it. Could we bring a REIT on chain? That could be cool. But the costs are just so prohibitive that we're not looking at it right now. But what it enables people to do and to participate, I think, is phenomenal. One thing that I'm glad you brought this up because I'm sure there's a workaround. There's workarounds for almost everything in the US specifically. So For example, I
Mm.
probably shouldn't say this, but I'm going to say it anyway. So, for example, hopefully this helps somebody out there. And for some people in the Web3 space, you don't really care about regulation anyway, and you're just flying by the seat of your pants and it's Wild West territory. But if you want to bypass not being a broker dealer, for instance, the way that you do that, and I say this because of REITs and a bunch of other stuff, there's ways to avoid doing that. So if you launch a platform and you take a platform fee because you're offering services on your platform like a dashboard or monitoring or data or analytics or whatever it is, now your fees are platform fees. And your platform fees could be $100,000 a year, right? They could be whatever you want them to be. And you could have platform fees instead of taking what would traditionally be a broker dealer fee, right? And so I say this because, and I have to dig into REITs a bit more, but there's almost always a solution. You just have to package it differently. It's so ridiculous. So instead of, for example, so
It's
I said we'd take 2% earlier, we won't actually take 2%. We're going to take a platform fee that will provide services to people via dashboards and analytics on our platform because we're not a licensed broker dealer. Can we partner with the broker dealer? Yes, of course we can. But if anyone wants to dig around long enough to see what everyone in the world is doing today with different language and services that they're providing, there's dozens, if not hundreds or thousands, that are doing this platform fee thing instead of becoming a broker dealer. And so with REITs, I have to dig in a bit more, but I'm sure there's regulation crowdfunding you can do to enable people who don't have as much capital to participate. We could go that route. We could look into it. There's limitations. I think the cap is $5 million. And so we would hit that. Maybe we could do that. Plus, we have to do Reg D as well. So once we get our first loan offering done, in tandem, we'll be filing Reg D because it is a securities offering. Anytime that you're promising somebody money, their principal plus something, it's a security. And so we do have to file it as a security offering. We could, in tandem, also do Reg CF, Reg crowdfunding to enable non-accrediteds to participate. And I don't think it would be that expensive, actually. So we could look into that. And I say this because this might cover part of like what REITs are doing. And in our platform, you can also invest in region specific. So if you do want to support Baltimore, you do want to support Oakland, California, you do want to support Cleveland, like wherever, you
cool.
can do that. The challenge though is making sure we have something available in your region. And it's not like we're going to always have something in Austin or whatever and outside of Denver. It just depends.
Yeah, no, makes sense. Yeah, the flexibility of language to make it do what you want. It's pretty amazing. It is. Okay, so you mentioned you have these couple deals that you're trying to push across the finish line. Do you have a timeline for when you expect that to happen and when you hope to launch the platform?
Yeah, so we're looking to have this fulfilled by the end of next month. We just finalized the deal structure with the borrower, and so now we're going back out to our investor base and having conversations right now. And so by the end of next month, we hope to have that wrapped up, and we'd like to have the platform live and ready by, if not by the end of this year, then early next year, but it's soon. Like we vibe coded all of the product demo. If we could vibe code the marketplace and try to do our own back end work, it's probably going to be atrocious. And so it's not that much. We don't need that much to get the platform built. Smart contracts and audits aren't so much, like less than $100,000, and we could definitely get it done.
Cool. That's exciting.
Yeah.
The core objective of this piece of this series that we're doing is to amplify your work and to get you in line three the support that you need right now. What can Kernel do to support you at this moment? What is of greatest need?
We're always looking for great partners, folks who want to join the community to whatever extent they're interested. And of course, if you're an investor, an angel investor, and you want to get involved, we'd love to find time to meet.
Cool. Um, and I had another question for you, because the last time we spoke, we talked a little bit about the future vision of Purpose for Profit, and you talked about how you would hope to rinse and repeat the model if you were able to prove it out
Yep.
and make it work
Yeah. Yeah.
for affordable housing. Is that still on your mind?
It is. It's not as prominent because I'm so deeply entrenched in housing and just getting everything moving forward. There's so much to do that it's a lot, right? There's just so much to do that thinking about another vertical or another area that could use support, it feels so far away, even though it probably could be 4 or 5 years. So yes, thanks for bringing that up. So the idea in this model is that you put the core contributors, like the subject matter experts, instead of having them come in like they do in a lot of product development in businesses as like an advisor, let's put them at the center. It's really their knowledge and their experience, and they're the customer. So let's put them at the center. Let's help them also get rewarded and rinse and repeat. And so we're starting with housing. We can move that to food and ag. We can move that into education. We can do that with healthcare. It's anywhere where there's privatized services with a public element as well, public and community element, but we can do this with the big vision of how might we coordinate as people with specific interests in specific industries to help coordinate as people and move funds and resources where they need to go to help move things forward. But yes, that's definitely still on my mind. 100%. That's just one of like a lot of things that I have to think about right now. But yeah.
Yeah, no, definitely. You don't have to worry about that one right now. And my last question for you, it was kind of a theme throughout the beginning of your career that you were looking to make impact, continue to find yourself in a place where there was some really interesting innovation happening, but you ultimately didn't feel like you were impacting and supporting the people that who really needed it. Do you feel like you're doing that now?
Yes, absolutely. I think that the work that we're doing now is scalable, and some people might not like that word, and it feels like there's going to be extraction because it's scalable or it's not localized and all these other things that people talk about when it comes to growth. But being able to get money out to folks who can build 50, 100, 1,000 homes that are affordable or for workforce housing is going to be far more impactful than us getting funds to a person or to 10 people. And so, yes, additionally, the partners that we're working with, the borrowers that we're working with, they all work with community organizations as well, nonprofits essentially, that are on the ground in the communities where they work. And so, although we won't be as hands on, yes, we definitely feel like the work that we're doing is impactful. Absolutely.
Great. Yeah, I'm really happy to hear that. And actually, I lied. I have one more question that you reminded
Okay.
me to ask. It was something that you mentioned early in the conversation when you talked about the borrowers, the developers asking questions about if they can pass along some of the token benefits to the communities themselves and the people that they're serving in different ways. And that sounds really interesting and potentially really powerful, especially from a governance perspective. Has that conversation matured? Is that in process or is that going to happen?
That's the plan. And so it's been requested. And one of our borrowers in San Francisco, or potential borrowers, they're building cooperative housing in the Fillmore district. It's all affordable based. There's a community center on the bottom. For them, it's really important to help with wealth generation for the community that they're serving. And so they're the first developer that asked us specifically, how can we get these tokens to the community that we'll be serving ourselves? We have on our product demo, there's a section where the borrower can see their token allocation and they can set up time to meet with us to develop an interests and incentives program. And so help them with their tokenomics, essentially, how they want to allocate their tokens. They have to manage it themselves. We're not going to manage a token at a time, like 10 tokens being distributed. Definitely not doing that. But there's services like Unicorn out there and others where we can help our partners set up an account, set up where they're going to manage their tokens, set up the rules for distribution, for claiming for rewards if there's problems. And so, yes, that's already been requested. There's another partner of ours in Oklahoma City who's not Web3 friendly, but who's already giving their tenants equity in the buildings when they lease. So they're leasing and they're now becoming an owner or co owner in the building where they're leasing, even though they're not buying it. And so we've already found that we have a lot of borrowers and partners who are very aligned with us when it comes to not only wealth generation, but collaborating with the people that you're working with and co-governing, co-creating together instead of it being this landlord owner model. And so they would be another really good example of a partner who we know would be interested in distributing tokens to their community base as well. People still have a lot of questions And some have hesitancy. So there's a large impact realtor we talked to last year who was scared that we would onboard people to crypto and then they would spend their money like at a casino. And now we're just bleeding people of the little dollars that they have. When I shared with her, like, no, these are something that they would be given, they don't have to pay for them. Like, this is a developer who's choosing to give them away. She still was a little bit hesitant, almost like it was this gateway drug. And I think that it's interesting. So she had this interesting perspective. We could have a long conversation about this paternalism and do people need to be parented? Should you give people access to things? The US is not considered one of the top financially free countries, quote unquote, in the world. I think it's Singapore, Canada, Hong Kong, Australia, and a couple of others that are at the top. But the fact that people can't access money the ways that other people can, or get access to loans at affordable rates like others can in other countries, is just crazy. And so I think part of it is this constantly wanting to control and baby people. If there are some not barriers in place, I'm trying to avoid saying regulation because everyone's so anti-regulation, but if you have some kind of guardrails in place, if there's education, if there's support, that's the best that you can, but what else are you going to do?
Yeah, no, interesting. Yeah, I mean, when you've been burned and historically marginalized, you can't blame somebody for being hesitant to get involved with something like this, especially in a place like the US, which, as you said, isn't financially free and is a little cutthroat in its approach to money. But those cooperative examples you gave, those are beautiful. I didn't know that was happening readily, and I hope that continues to persist. And it seems like Lane 3 is really supporting the cultivation of that growth of that model, which is really cool.
Absolutely. Yeah, it's not happening in mass. Yeah, but it is happening. Yeah,
Yeah. Well, hopefully you help it happen in mass.
that's right.
So that's all I got.
Okay. Thanks for taking the time. I appreciate it.
Absolutely. Thank you as well for taking the time 3 or 4 times to make it happen.